Having professional indemnity cover is a compliance requirement for financial advisors. Basically, if you don't have it, you can't provide advice. But securing this type of insurance has become increasingly difficult. Christina Kalantzis from Alexis Compliance and Risk Solutions is with me to discuss this matter. Welcome, Christina.
Hi, Darren, and thank you for having me.
Look, we might go right to the heart of one of the issues, and that is there seem to be fewer and fewer underwriters servicing advisors' PI insurance cover needs. Right now, look, how many underwriters actually are there servicing the market?
Well, you're right, Darren. We've got 5 PI underwriters at the moment who are insuring financial planners. And even though we've got 5, it doesn't mean that all our financial advisors and the AFSL licensees are actually getting adequate cover. One of the major issues that we had was AIG Insurance, which was one of the biggest underwriters and has been with the Australian market since inception when PI insurance was mandatory, exited the market last year. And that put a big spanner in the works as well. So it's difficult for our licensees to obtain the insurance cover that they like. And I'm sure we'll talk about the exclusions and some other issues that come as a result of that.
Now, I'm assuming that logically, the fewer underwriters means that the cost of cover and probably the quality of cover is suffering as well.
So originally they'll do a percentage of what the person's turnover was, but what we're seeing at the moment for small licensees, it could range anything between $12,000 to about $30,000, the PI insurance starting position. Not to mention, I think all our licensees would have received their ASIC levies this week as well, and they get additional fees with ASIC requirements, and now they've got the PI insurance requirements that have gone up as well. So it's not that it's an expensive industry to function within from a PI perspective, and then we've got compliance, we've got education and the like. But then it's also the insurance cover that the guys get have certain exclusions in them as well. And they need to be aware of what those exclusions are.
Now, Christina, what has actually led to this situation?
Well, I've been in the industry personally for more than 20 years, and I have seen changes in the compliance requirements for advisors. We had FOFA, the Future of Financial Advice. We had FSR, the Financial Services Regime as well. We had the Ralph Royal Commission, which was the one most recently, and we're all waiting with bated breath to see what comes out of the Quality of Advice Review as well as a result. We have seen, and I can personally say that from the clients that we service as well, it has become compliance overloading. And there is this fear from the advisors and the licensees to protect the advice that they're providing. And we're seeing voluminous amounts in the SOAs. It doesn't help when you get the regulators banning quite a lot of advisors from not adhering to best interest duty, which I personally think is very difficult to adhere to if you actually look at the requirements under the Reg Guide 175, which is more than 40 pages, has been dedicated to best interest duties. So there's a lot of things going on in the industry, and past practices as well hasn't been any good with the agribusiness subprime market, and also the remediation that's been going on with the banks. There's a lot of stuff going on at the moment.
Ultimately, what effect is this having on financial advisors right now?
They're finding it difficult to get affordable PI insurance. I'm asking them to review the terms of the PI insurance with their brokers to make sure that they're not breaching the requirements of Regulatory Guide 126. I don't think a lot of licensees are aware. They are aware that you need to have PI insurance, but are they aware that the PI insurance needs to be adequate and in line with the requirements of RG 126? The reason why I say that is because last year, ASIC just released an updated Reg Guide on breach reporting. One of the examples that they use that a licensee needs to report to ASIC is a breach is if they don't get adequate PI insurance. which is interesting because I think a lot of people hold in and they try and get the PI insurance, but you've got to read the terms, make sure from a compliance perspective that you have adequate insurance. And if you don't, you apply to the regulator for relief.
Okay, well, thanks for sharing some of those insights with us today, Christina.
Not a problem, Darren. Thank you for having me again.
This issue will be discussed in greater detail at the Financial Observer Professional Indemnity Symposium to be held at Rydges World Square in Sydney on Thursday, 9th of February. If you would like to find out more about this event or register for it, please refer to the details you can see on your screen now. Look, thanks again, Christina, and I look forward to continuing this discussion at the symposium.
Thank you.